Forget about averages, forget about standard deviations. You need something else. You need a little bit more exotic math. I mean, it is a mathematical thing. It is a model and it has been spot on for the last 3 months. You know, the entire reason that we have a model is to protect against our own emotions, right? Because I know very well how I felt during that entire 3-year period. In a way, that in the depth of the COVID crisis or the China crisis, you feel bearish, very, very bearish, and you're tempted to sell everything, and I think the world falls apart. That's when the model saves you, right? And the same thing is true when the model, when the price is up, and everybody is FOMOing. It's especially in the top when Elon Musk tweeted that Bitcoin tweet, and everybody was FOMOing. I was like at the high part of the standard deviation band, so don't get too excited. So even then, your greed and fear is sort of tamed by mathematics, and I like that so much. I need it because you cannot invest without the mathematical guidance, and you will be ruined by your own emotions. And by the way, I know some hedge funds, it's more than one or two, that use this exact model to do this trade. So to buy when it's at the outer bands, at the lower bands, and to sell when it's at the upper bands. You could, if you do it well, it's very risky though, but you could make money trading this thing as well. It's more fundamental than we might think at the moment it is, because it looks like a fitted line, the stock to flow model. But I think the scarcity argument is a fundamental argument as well, because that's also how I started out making that model, right? Because there's other scarce assets like gold and silver and diamonds and real estate. And it would really, really surprise me if real estate, which has a much higher stock to flow value than gold and Bitcoin, for example, if the value would be lower. And likewise, if Bitcoin surpasses gold in stock to flow, in scarcity, it would really surprise me if the market wouldn't put a larger price ticket on it. So there's some very fundamental scarcity force at work here. That's what I think. And we haven't figured it out completely yet, because it's now in its rudimentary state, if you will, like put out in 2019. But I'm very, very curious what people, or maybe myself, what we will find in the future, if the relation can be tightened or even defined better. And then I also agree with the fact that, for example, the human nature will not change. So greed and fear will drive this market as well. So there's this scarcity force. There's all sorts of black swan events like COVID in China, but there's also greed and fear. So people will be greedy. And when they go 2x or 3x, some will sell, but others will think it will go 10x or 100x, and they will stay and buy, and then
leverage.
And leverage, yeah. And the same when we go down, then people will be. There's people bearish. Oh, it's all over. This was the top. We crashed to 64, or where are we at the moment? But look at what you're saying. We crashed to 64. That's a crazy price, right? We'll be saying we crashed to 100,000 a couple of months from now. That'll be fine. But the greed and fear, I'm sure, will be there. People don't change. Some people say that's a wide range, but if you look at the y-axis, you see 8 orders of magnitude, and that's enormous. If a model is right over 8 orders of magnitude or 7, that's crazy. And I have investors, big investors, traditional investors, right? Institutional investors that came to Bitcoin and that came to Bitcoin and stayed there because of this chart. Maybe not so much the model, but just the price chart. Seeing this exponential growth over 6 or 7 orders of magnitude in 10 years, over that long period, that tells you something is going on. There is a sort of constant growth, adoption, or whatever there. And investors, traditional investors like me, have never ever seen that in their entire lives. I mean, the closest thing is maybe Tesla or Google and Facebook. And that's a bit of a wrong example as well, because big tech stocks were very volatile in the beginning, so just after the IPO. And then the volatility decreased and they just went up and up and up because of adoption. And with Bitcoin, it's slightly different because the volatility doesn't really go away. It's still a 80 to 100% implied volatility asset, those implied volatilities, you can measure those from the option prices. That's what the option market calculate for the volatility. 100% volatility is crazy. There really is some underlying trend going on, and an institutional investor can watch for hours at this chart and shake his head and say, well, this isn't possible. This cannot be. And it's there. And with that high volatility as well. So the volatility sort of blurs everything on smaller time scales. But if you look at this chart over 10 years, it's just the most amazing thing you've ever seen as an investor. But my model is slightly different, because the 200-week moving average and frankly, most technical analysis is taken from normal markets, equity markets, foreign exchange markets. And Bitcoin has this very specific nature, this exponential nature that we talked about, that it goes over 6-7 orders of magnitude in 10 years time, and with a lot of volatility as well. It's not normally distributed at all. Forget about averages, forget about standard deviations. You need something else. You need a little bit more exotic math. Let me say this also, right? It's a floor model. It shouldn't be under those measures, those numbers. So 98 for November and 134,000 for December, unless there is a black swan, of course. I mean, it is a mathematical thing. It is a model, and it has been spot on for the last 3 months. I could be wrong, because there could be a black swan event. There could be a thing, but at least to make it very concrete, if we don't hit the 98,000 in end of November, that would be a first on this specific indicator in the entire history of Bitcoin. So in the entire 11-year or 12-year period. That's why I can be so confident about it. And of course, it's in line with stock to flow prediction, right? So the 135,000 end of this year would be crossing that white line in the chart you show right now. And it would be exactly in line with the stock to flow model. And so that gives me even more confidence that in both the floor model and the stock to flow model, that there's both two clocks telling the exact same time. So I think the greed and fear in people will stay. That's causing the FOMO tops and the crash bottoms. And that's amplified, of course, by leverage, people that lend money to invest in this already very volatile and high return asset, which is very stupid. You should never ever do that. That's you're certain you take it to hell. You will get liquidated, but it's fun, of course. That's basically it. So I think indeed that it will not be a super cycle just yet, but it will have a FOMO top, and that can be even higher than we might expect, right? Because we look at this chart, FOMO top in 2017, 20,000 was about 3 times above the 7,000, 7,500 model line. If we would project that on today's stock to flow value of 100,000, you would get a top of 300,000. But then if you look at 2013, it was like 10x above the model line. So that would imply a $1 million top in, say, 2022, which is unthinkable right now. But we did it in 2013 and actually in 2011 as well. So it wouldn't be it wouldn't be impossible. But I certainly think that after that, the fear kicks in, something happens, some people take profit or are going to hedge themselves with futures, and the whole thing starts tumbling down and we crash back.